Let's talk more about the health of the banks. Joining us now is Sheila Bair, former chair of the FDIC. She is now director of the Volcker Alliance. Sheila, great to have you with us.
Thanks for having me.
We were just talking about the underperformance of banks, the stocks. And we also were talking to a real estate hedge fund investor who basically said there's a big downturn yet to come in commercial real estate. It's not reflected in the CMBS market. You yourself say that credit losses take time to work through the system. So what does that mean for your view of the banks?
So I think you do have to distinguish between banks that have significant capital markets activities and those more, the bread and butter is taking deposits and making loans. So the banks that have significant capital markets activities have actually been enjoying, significant earnings and revenues from those businesses. And so I think you do need to distinguish in terms of the business model. For the banks that their primary focus is lending, and frankly, they're the ones we need right now, especially households and small businesses, but it does take a while for those losses to flow through. Just because you don't, a loan has to be delinquent a certain number of months before it's counted as a troubled debt. A lot of loans, there's forbearance now under the CARES Act or through regulatory approvals that still aren't having to be counted as troubled debt. So all of that can kind of mask what eventually may be the credit losses for bank lenders, those especially, again, who primarily lend, and that's how they make their money. So I think there's still a lot of questions. And even though the investment banks and those like JP Morgan Chase that have significant capital markets operations are benefiting from all the Fed support, especially in the bond market, especially in fixed income, I think there's only so long that can go. I think what corporations in the U.S. have issued something like $2 trillion in debt now, almost $2 trillion, which is a year, for a whole year is a record. So you kind of wonder how much longer that will continue. But it's going longer than I thought. And in terms of the big banks, they are in better shape than I thought they would be at this point. I still think they should be suspending dividends, but because of the Fed interventions and the capital markets, they've been doing better.
Sheila, I'm not asking you to play stock market here, but Warren Buffett recently pared down his U.S. bank exposure. In terms of like a name like Citi, for example, trading at 62% of what they tell us tangible book is that telling you something of a larger problem that we're just ignoring or missing?
Well, I think that's another problem with these very large institutions. There's really an issue about whether they're too big to manage. And so you are always having these surprises, whether money laundering is the more recent thing. It looks like Citi, they've infamously made a $900 million payment to Revlon's creditors they shouldn't have made. It looks like this is, according to press reports, is endemic to a larger problem they had just with their systems and the lack of integration of their systems and centralized risk management, which I must say was a problem they had in 2008. I was very disappointed that more of that hadn't been fixed, but they are very large, very complex, very difficult to manage. And so you always have these regulatory surprises, whether it's missed payments, whether it's anti-money laundering, failure of controls. That kind of goes hand in hand with investing in a large bank. You're never quite sure what you're going to get, what the paper may say the next day.
Sheila, it's Karen. Thanks so much for being on our show. Let me ask you, you said it takes a while for losses to go through the system, but we've seen front-end loading of loan loss reserves to cushion those losses. What do you think about the size of the reserves that have been, I think, enormous so far, and how will that be enough?
Well, that's a good point, and because we had a new accounting standard this year, so they front-loaded a lot of the losses more so than they would have been certainly during the crisis when we were constantly paying catch-up as these loans were going bad, trying to catch up with reserves just at a time when their earnings were under challenge. So that's a fair point. I'm not a bank supervisor anymore. I can't see what the examiners are seeing. I'm going to take it on faith. I think the examiners are absolutely on top of this, and so that those loss reserves are at pretty robust levels. That said, though, there has been some regulatory forbearance in terms of, letting loans become delinquent for a longer period before you have to start counting them as distressed loans. And I do think that may be making bank balance sheets and financial statements maybe a little healthier than they might actually be. And then, of course, if there's a resurgence, all bets are off, because all of this is based on models and what your best guess is over various scenarios of what, through the cycle, through the life of the loan, the losses will be. And that could change if we get into another bad situation with the pandemic, where, again, banks are very exposed. So I wouldn't. I know you're long now, and I wish you the well. I heard that. I wish you well on that bet. I'm not owning any bank stocks. Whatever it's worth. I don't advise on the stock market, but I do not own any bank stocks right now.
That's maybe very telling, Dan.
Hey, Sheila. Hey, Sheila, it's Dan. Last week, you tweeted something that kind of caught my eye. It was about spending here in the U.S., and you're talking about a busted budget here, and you're talking about what some of the projections are, or what. So, can you talk a little bit about budget deficits, what it means for growth, where we are, and I guess your point was, are we thinking about this the right way?
Well, I think, the Fed's, bless their heart, the Fed's buying a lot of federal debt. G-Pal's got our back, so we can keep issuing it. Nobody else is buying it. The Fed's going to buy it. So good. So we can fund deficits for as far as the eye can see. But I don't think that should absolve us of responsibility of being smart about how we spend the money. And there's not enough focus on that, and not just with regards to federal government spending. You look at that $2 trillion of corporate debt that's been enabled this year through the Fed's interventions, interest rate policies, and direct interventions in the corporate market. Where is that money going? How are we spending it? Private payrolls are below estimates. I still see a lot of dividends and buybacks going out, and that's fine. You've got the earnings to do it. But if you're issuing debt to pay dividends and do buybacks, I don't think that's a really particularly productive use of the Fed going out and taking the risk and backstopping the corporate debt market. So even in the private sector, in terms of the monetary policy and the amount of additional debt that's facilitated, what are we doing with it? And I don't see it flowing down to households. And just longer term, I think that tweet was really more about some of the other programs we have. These are more longstanding issues, not tied to the pandemic. But we use intermediaries for so many of these federal programs, whether it's healthcare, whether it's education, whether it's financial services, housing. And to what extent are these programs becoming co-opted by the intermediaries? So, we spend so much more, especially on education and healthcare per capita, than any other developed country in the world. And we get worse results, frankly. And that's because I think the design of a lot of these programs have been co-opted by the intermediaries, whether it's the schools, whether it's the health insurers or the healthcare providers. That's the way to the economic incentives are misaligned. The money's going there, not to the ultimate, end user, the public.
Right.
So I wish we would get a little smarter on that, because we spend a lot of money already, and nobody really talks about why are we getting such bad results of spending these astronomical sums. The answer always just seems to be, with both parties, spend more, spend more, spend more, without asking how we are spending it. That's really something I wish we would focus more on in this presidential debate, especially.
Sheila, we're out of time, but I got to clarify. Okay. Do you not own banks because you choose not to own banks, or because of a conflict of interest policy that you have to abide by, or?
It's not a conflict of interest policy. It's just maybe I shouldn't have said that. I don't, a lot of it's just, you couldn't own bank stocks as when I was a regulator. But no, I have not weighed back in. I think I just still worry about them. I think especially the very largest ones, I don't feel like I have as good a handle as I should, understanding what they're about. And the Citigroup situation is a good example. As you know, I was a big critic of Citigroup. Mm-hmm. I was a big critic of Citigroup. I thought they had improved a lot. And I've been very disappointed to see what I'm seeing now in terms of a lot of the problems that they should have been fixed that apparently are not fixed. So it's the endless opportunity surprise with the big banks is why sure. I don't really have exposure there.
Sheila,
but
thank you.
I don't advise on equity. I don't advise on the stock market.
I just want to get clarification. Thank you so much, Sheila. Appreciate it. Sheila Bair.